Two families, same city, same income, same year. Family A sees inflation rising, news channels screaming recession, layoffs in tech, markets falling. They panic, they stop their SIPs, they delay investing, they keep money idle in savings, they postpone risk. Family B sees the same headlines, but they ask a different question. What is this cycle creating? 5 years later, the gap between them is massive, not because of income, because of positioning. Right now, the world feels unstable. Inflation is high, interest rates are elevated, companies are cutting jobs, markets are volatile. For most middle-class families, this feels dangerous. But historically, this is how wealth cycles begin. 2008 financial crisis, 2020 pandemic crash, dot-com collapse. Every major correction created fear first, then opportunity. And the middle class had a choice: freeze or position. Let's understand what's really happening. When interest rates rise, easy money disappears. Speculation reduces, overpriced assets correct, weak companies struggle. This feels negative, but it does something powerful. It resets valuations. In simple terms, assets become more realistic. During 2020 to 2021, many stocks were priced for perfection. Now, many quality companies are trading at reasonable valuations. If you're investing through disciplined SIPs and index funds or mutual funds, market volatility works in your favor. When markets fall 15 to 20%, your SIP buys more units. You accumulate more ownership for the same money. 5 years later, that accumulation matters. Family A stopped investing because of fear. Family B continued. Same income, different mindset. Now let's talk about interest rates. High rates feel painful if you're borrowing, but they reward savers. For years, fixed deposits gave low returns. Now, FD rates are stronger. Debt instruments are more attractive. Government securities offer better yields. This allows middle-class families to strengthen emergency funds while earning something meaningful. That's rare. Usually, safety gives poor returns. Right now, discipline is being rewarded. But here's the risk. Uncertain environments punish over-leveraged households. If you have high EMIs, credit card debt, personal loans, lifestyle inflation, then volatility feels like a threat. But if you have low fixed costs, 6 to 9 months emergency fund, disciplined investing, strong skills, volatility becomes opportunity. The same market, different outcomes. Let's make it practical. Imagine a middle-class couple earning 12 lakh rupees annually. Monthly expenses 70,000 rupees. Family A upgrades lifestyle. Bigger house, new car, EMI, stops SIP when market falls, keeps no emergency buffer. Family B does something different. They maintain 5 to 6 lakh rupees emergency fund. They continue 20,000 rupees monthly SIP even during market dips. They avoid unnecessary loans. They spend 5,000 rupees monthly upgrading skills, AI tools, finance, communication. 5 years later, markets recover. Their accumulated units grow significantly. Their skills increase earning power. Their stress is lower. Family A still catching up. Here's the uncomfortable truth. The middle class doesn't lose because of low income. They lose because of emotional reaction. When markets fall, they sell. When markets rise, they chase. When inflation rises, they panic. When layoffs happen, they freeze. But wealth isn't built in comfort. It's built in correction. Now let's talk about pros and cons clearly. Pros of this environment: better asset entry points, higher safe returns, reduce speculation, long-term compounding advantage. Cons: job uncertainty, slower salary growth, higher borrowing cost, emotional stress. The key is not aggression, it's structure. Strengthen emergency funds, control fixed expenses, continue disciplined investing, upgrade earning ability, avoid emotional decisions. Because this is not a crisis phase, this is a transfer phase. When weak structures collapse, strong ones accumulate. Every cycle does this. The middle class has one massive advantage: time. If you invest consistently during corrections, compounding does the heavy lifting. But if you wait for comfort, you'll always buy expensive assets. 5 years from now, this period will be called the opportunity phase. The only question is, will you look back and say, I was scared, or I was positioning. Because the economy moves in cycles. But discipline, that's a choice. And in uncertain times, disciplined middle-class families quietly build wealth while everyone else debates headlines. The opportunity is here. Are you structured enough to take it,